Have you ever looked at a company, seen these amazing cash reserves, zero debt, and thought, wow, they must be crushing it? But then maybe the core business itself seems a bit choky. It's this really interesting situation, and that's exactly what we're digging into today. We're focusing on DN Networks Limited, specifically their unaudited results for the quarter ending June 30, 2025. We've got their investor presentation, the official board meeting stuff with the auditor reports, and yeah, a whole bunch of questions we put together to guide us. Our mission really is to cut through all the jargon, pull out what actually matters, and give you a kind of shortcut to understanding DN networks right now. We want to flag the surprising bits, connect the dots, hopefully give you a few aha moments without drowning you in numbers. Okay, so maybe let's start with the basics. Just quickly, who is DN Networks? For anyone maybe not familiar, they're mainly a big cable TV distributor in India, right? Started back in 2007. They're in like over 450 cities and towns spread across 13 states. So quite a reach.
Yeah, that's the main part. But what's really interesting and kind of crucial here is they also have a big foot in the broadband game. That's through DN Broadband Limited. It's a wholly owned subsidiary set up around 2011. So you've got this dual focus, cable and broadband, and understanding that is key, especially with how fast the digital scene is changing.
Right. Okay. So let's look at those Q1 highlights then. What jumps out immediately? I mean, the first thing I saw was zero gross debt. That's pretty unusual, isn't it, for any company, really?
It really is impressive, zero debt. And alongside that, you see this healthy cash balance they're reporting ours, 3,215 crores in cash and equivalents.
Just for context, 3,215 crores. That's about, what, 32 billion rupees? Or around 380 million US dollars. That's significant cash.
It is. And then you see the consolidated PAT, that's profit after tax, the bottom line at ours, 54 crores. Oh, and they mentioned a 96% online collection rate, including the subsidiaries. Seems efficient.
Okay, so high cash, no debt, decent PAT on the surface, good collections.
Exactly. But the big question pops up right away, doesn't it? How do these flashy headline numbers actually mesh with what's happening in their day-to-day business?
Let's get into those details then. Consolidated financial performance. Total consolidated revenue for Q1 comes in at Rs 241 crores. But here's where it gets a bit more nuanced. Compared to the last quarter, Q4, revenue is actually down 3%, and it's also down 3% compared to the same quarter last year. So yeah, a slight dip.
Right. And if we, break that down a bit, you see some shifts happening within that revenue. Take subscription income, that was Rs 105 crores, but it actually fell 1% from the previous quarter. And more significantly, it dropped 17% compared to last year. That's a big year-on-year fall for subscriptions.
15%, wow.
Yeah. But then you look at placement and marketing income, that's things like carrying channels, advertising perhaps, that was Rs 129 crores. And that number was up a healthy 21% year-on-year, even though it dipped slightly, like 2% from the previous quarter.
Okay, so subscriptions down significantly year on year, but this placement income is up quite a bit. Feels like the mix is changing.
Definitely suggests a shift in where the money's coming from, maybe less reliant on the pure subscriber fee model.
Makes sense.
Yeah.
What about the cost side? Total costs, you said, were pretty stable, around 220 crores for the quarter?
Stable overall, yes. But dig into that and you find content costs, what they pay broadcasters, actually went up. Up 5% compared to last quarter and also up 5% compared to last year. Reached Rs 150 crores.
So subscription revenue is falling, but the cost of the content they need for those subscriptions is rising. That sounds like a squeeze.
Exactly. That's the pressure point. How do you manage rising content costs when your main subscription income is shrinking? And that pressure, well, it flows right down to their operational profitability. We see their consolidated EBITDA.
Right, the earnings before interest, taxes, depreciation, amortization. Kind of a proxy for operational cash flow.
Yeah, a common measure. And it stands at only 21 crores for the quarter. That's a big drop. Down 26% from the previous quarter and down 25% from the same quarter last year.
25% year-on-year drop in EBITDA. That brings their margin way down too, right? To just 9%.
Only 9%. So operationally, things look much tighter.
Okay, but wait. This is where I got a bit confused earlier. You said the EBITDA, the operational earnings metric, plunged 25% year over year. Yet, the overall profit after tax, the PAT, was Rs 54 crores. And that was actually up 24% year over year. How does that work? How can operational earnings fall so much, but the final profit goes up? What's bridging that gap?
And that is the million-dollar question, isn't it? Or rather, the 3,215 crore rupee question. This is exactly where you have to look at the balance sheet. That huge cash figure, Rs 3,215 crores, it's not just sitting there idly. There's a note from the auditors, a really fascinating detail that kind of unlocks this puzzle.
Okay, I remember seeing this. This is the really interesting part. The auditors point out, what was it? Money from a share issue back in 2019. Yeah, proceeds of ours. 20,450 million, that's 2,045 crores from something called a preferential allotment. Remind us quickly, what's a preferential allotment? Is that like a private fundraising?
Exactly. It's when a company issues new shares, but not to the public market. They sell them directly to a select group of investors, a way to raise a big chunk of capital, often quickly.
Okay, so they raised over 2,000 crores back in FY 2019.
And here's the kicker, according to the auditor's note. That money is still, years later, invested in mutual funds and fixed deposits. It's marked as pending utilization. They haven't actually used it for the business yet.
Wow. So a huge chunk of the cash on their books isn't from running the cable and broadband business day to day.
Precisely. It's from this capital raise that happened years ago, and it's just been sitting in investments. Think about it like this. Imagine a bakery that's maybe losing a bit of money on every loaf of bread it sells. But 5 years ago, it got a massive inheritance, put it all in the stock market, and now the dividends and gains from that are making the bakery look profitable overall.
Okay, that makes sense. So the profit isn't really coming from selling bread or, in Din's case, cable subscriptions.
It strongly suggests that, yes, the other income, the interest and returns earned on those are 2,045 crores of investments. That's likely the main reason why the overall payday is up, even while the core operational EBITDA is way down.
Right. That income from investments is masking the weaker performance of the actual business operations.
It certainly appears to be the major factor explaining that discrepancy we talked about.
So, okay, if a big slice of their cash and their profit is tied to these old unspent funds, what is the health of the actual cable and broadband businesses? Are they making any money on their own?
Well, this is where the segment information becomes really illuminating. It breaks down performance by business unit. And for Q1 FY26, the cable distribution network segment, it brought in revenue of about Rs 2,353 million. But its segment results, think of that as its operating profit or loss before corporate overheads was actually negative. A loss of Rs 21.01 million.
A loss on the cable side. Okay. What about broadband?
Same story, unfortunately. The broadband segment had revenue of roughly Rs 105 million, but its segment result was also negative, a loss of Rs 12.70 million.
Okay, so let me get this straight. Cable business, losing money at the operating level. Broadband business, also losing money at the operating level.
That's what the segment results indicate for this quarter, yes.
Yet the consolidated company reports an overall profit of Rs 54 crores.
Mm-hmm.
So it really does seem to confirm it then, that other income from the invested unutilized funds isn't just helping the bottom line, it's practically carrying it. It's the only reason they're showing a profit.
It appears that way, which naturally leads to some pretty big strategic questions, doesn't it? You've got a company operating in a really tough competitive market. Cable TV faces huge disruption from streaming. Broadband is hyper-competitive.
Yeah, the whole shift to digital OTT platforms.
Exactly. So how does a company navigate that landscape when its core engines, cable and broadband, seem to be running at a loss, especially when it's simultaneously sitting on this massive pile of cash, over 2,000 crores that it raised years ago and hasn't deployed?
It's a very unusual position to be in, holding on to capital while the core business struggles.
Particularly in the Indian context, where the media and broadband landscape is evolving so rapidly, you'd think deploying capital strategically would be crucial right now.
So let's try and wrap this up. What are the main takeaways from this deep dive into DN networks? We started seeing this picture of, impressive finances, huge cash, no debt. But digging just a little deeper reveals this really unique, almost paradoxical situation.
I think the absolute key takeaway is understanding that split. On one hand, yes, a very strong cash position. Zero gross debt. Looks solid. But that strength seems largely derived from those unutilized funds raised back in 2019. On the other hand, you have the current operational reality of their core businesses, cable and broadband, which, based on segment results this quarter, are loss-making.
It's a stark contrast.
It really is. It's a fascinating snapshot. As you said, a company may be in transition or perhaps just waiting. It's hard to say from just one quarter.
Definitely. And it leaves us and you listening with a pretty provocative thought to chew on, right? What does it actually mean for a company's future when it finds itself in this position? Sitting on billions in unutilized cash while the businesses it's actually known for are losing money.
Bro.
How might this shape DN Network's strategy going forward in this super fast digital world? And maybe what are the long-term risks or opportunities for its shareholders, for its stakeholders, if that cash just stays invested, stays unutilized, or isn't put to work strategically?
Yeah, lots to think about there. How long can that disconnect last? What's the end game?
Definitely something to mull over. We'll leave it there for this deep dive.